Okay, let's talk about building an income stream that just doesn't quit. We're going to break down a really cool strategy for creating passive income that keeps flowing, no matter what the market throws at you.
And this quote, man, it just nails it. The Holy Grail. A high income stream that's also durable. Think about it. It's not too hard to find a high yield, right? But one you can actually rely on, one that won't just vanish, that's the real challenge. Getting both at once, yeah, that's the dream.
So let's get into the fragile income problem. Why are so many portfolios, so vulnerable? It really boils down to this. They're often a one-trick pony. They're built on a shaky foundation that depends way too much on just one thing going right in the economy.
I mean, take a look at this. Different assets have their day in the sun, right? You've got your business development companies, BDCs for short. They love it when interest rates are high. Then you have REITs, the real estate trusts, which thrive when capital is cheap and easy to get. And option strategies, they can really shine when the market is all over the place. But here's the kicker. If you're all in on just one of these, a tiny shift in the economic weather can completely wreck your income.
So, what's the solution? It's not about trying to pick the one perfect investment. Instead, the real secret is to build an unstoppable combination. We're talking about building a portfolio that's self-reinforcing by combining things that make money in totally different ways.
The whole idea is to lock these different income sources together, so they work like gears in a machine. When you do that, you create a portfolio that's basically disconnected from whatever crazy thing is happening in the world. Your income stream stays protected no matter what, making you, pretty much unstoppable. All right, first up, component number 1, the bedrock. Every solid income stream needs this. It's your anchor. The boring, super consistent piece that couldn't care less about the market's daily drama. And for this strategy, our bedrock is a specific kind of landlord, a REIT called NNN.
Now, NN isn't just any old landlord. What makes it so stable is something called a triple net lease. And this is a total game changer because it completely flips the script on risk. It basically shifts all the big, annoying costs of owning a property from the landlord straight to the tenant.
So what does that mean exactly? In a triple net lease, the tenant pays for everything: property taxes, the insurance on the building, and all the maintenance. So think about it. If property taxes go through the roof or an actual roof starts to leak, the tenant pays for it, not NNN. This shields NNN's profits from all those surprise costs that can just destroy a normal landlord's income.
And the proof is in the pudding. I mean, check this out. 36. That's how many consecutive years NNN has increased its dividend. 36 years straight. That means it sailed right through the dot-com bust, the 2008 financial crisis, the pandemic, you name it. That's what I call a bedrock.
Okay, so we have our stable, boring bedrock. Now let's move on to component number 2, the harvester. This is your volatility engine, and it's designed to solve a totally different kind of problem. In fact, this part of the portfolio is built to do well when things get chaotic. So, let me ask you this. What happens when the market just goes sideways? It's a huge blind spot for most investors, right? If the S&P 500 is flat for a year, a typical growth portfolio makes, $0. All your gains are tied to prices going up, up, up.
And that's exactly where our volatility harvester, an ETF called SPII, comes into play. See, unlike a traditional portfolio that just hopes for prices to rise, SPII is built to squeeze cash flow directly from the market itself. It actually makes money from all that choppiness, from that volatility, even if stocks aren't going anywhere.
So how in the world does it do that? Well, it's pretty clever. First, SPYI buys the companies in the S&P 500, standard stuff. But then it sells call options against them. And here's the magic. When the market gets nervous and choppy, the price of those options, what we call the premium, shoots up. SPYI is designed to capture that market fear and turn it into a cold, hard monthly paycheck for you.
And the result is, it's a huge dividend yield, sitting around 12%, and it gets paid out every single month. But the really critical part is when it pays best. This income stream is literally designed to perform at its peak when everyone else is panicking. It's cash flow right when you might need it most.
And if that wasn't enough, there's a pretty sweet tax advantage too. SBI uses something called Section 1256 contracts. And all you really need to know is that because of a special rule in the tax code, 60% of the profits are taxed at the lower long-term capital gains rate. And that's true even if you only held it for a day. It just means you get to keep more of that awesome income in your pocket.
Okay, so you've seen the first two pieces of the puzzle.
the stable bedrock, and the chaos-loving harvester. But it's super important to know that this is just the beginning. These are only the first two parts of a much bigger strategy.
That's right. There are two more components that really complete this whole income flywheel. You've got the banker, which is all about adding raw yield horsepower, and the accelerator, which acts as a funding source that helps the whole system feed itself. And when you lock all four of these pieces together, you get what the author calls this income flywheel. So if you want to see how the banker and the accelerator fit in and make this whole system work, you can dive into the full strategy in the original post. It's definitely worth a look.